Good morning, ladies and gentlemen. Welcome to the Monday Morning Minute. It is December 6th, 2021. Going to be a little bit longer since I've been out of town for a little while. I know you guys miss my face and all that good stuff, so let's get rocking. Every time I go out of town, it seems like the market decides it's going to freak out, so apparently I should never take a vacation. In any event, we have a new coronavirus variant. Everybody's well aware of that. Omicron. The bright side, I would say, is it looks like, for all intents and purposes, this is not nearly as bad as the Delta variant was in terms of hospitalizations and deaths. At least that's what the early data suggests. It's a little bit too early to tell for sure because we generally see about a 2-week lag time between initial infection and potential hospitalization. The information that I've seen so far, at least out of South Africa, suggests that we are looking at average hospitalization time at about 2.3 days relative to 8.7 for Delta, so that's a big deal. And released on Bloomberg this morning was also a study detailing specifically that the Omicron variant, or people that have tested positive for that specific variant, have a much lower requirement for O2 when they reach hospitalization status. So that is a good thing. Only time will tell how serious this is really going to be, but it seems like some of the risks that have been embedded into stock prices or some of the fear in the marketplace might be a little overblown. I think a lot of the drama that's been happening in U.S. stocks in particular stems from the conflicting data we're getting. Jobs report was pretty yucky last week, not fantastic at all. Also, we had record PMI, which suggests that we're seeing huge expansion in growth, but also really anemic job growth, which is weird. We're also predicting somewhere in the range between 6 and 7% on inflation coming up at the end of the week. And we also had the Federal Reserve saying that they could potentially taper faster. So the market has no idea what to do. We had stocks getting crushed, then a huge bounce, and then getting crushed again. And then we had Treasury yields going through the floor, super low real quick. So that means balanced portfolios were kind of doing what they're supposed to do, but it kind of flies in the face of the Fed tapering faster and possibly raising rates faster to stem inflation. So all sorts of stuff going on. Broadly diversified portfolios are going to be holding up best theoretically in this type of scenario. The ones that are going to struggle more are ones that are very heavy in equities because we saw VIX kind of go over that 30 mark that we've talked about in the past, going all the way back to the middle of last year when we talked about the VIX constantly. Seems like it's been a little bit of an afterthought recently, but it is back in full force, and it means something when volatility gets up in that 30 range and starts to creep higher from there. Fortunately, this morning what we're seeing is it's dropped back below 30. If we can get that thing closer to 20, that's a good sign. If you guys have any questions on what that really means to stocks in your portfolio in general, give me a call or shoot me an email at info@cfgfinancialplanning.com. Once again, biggest data point this week is going to be our CPI, our inflation index. That's the important one, and we are thinking over 6% is very likely and probably not a great thing in terms of the whole Fed tapering process. Remember, hope is not an investment strategy. Have a great week.